All right, let's talk Best Buy. They just dropped their Q3 numbers, and honestly, it's a bit of a mixed bag. They posted a really surprising beat that definitely caught Wall Street on the wrong foot. But their forecast for the holiday season, well, that tells a whole different story. So let's break down what's going on and what it all means for the stock.
So let's just jump right in. The number that absolutely lit up the screens after Best Buy's Q3 call, it was this one, 2.7%.
And what is that, you ask? Well, that's their comparable sales growth. Now, to put that in perspective, the street was looking for something like maybe 1.6%. So yeah, 2.7, that's not just a beat, that's a major beat. It really got everyone's attention right out of the gate.
So you gotta ask, how'd they pull that off? Well, it wasn't any kind of magic, just good old-fashioned execution. They brought in more money than everyone thought, and they spent less than they planned. A classic and very effective 1-2 punch.
Let's peel back the onion a bit and look at the actual numbers. Revenue, that came in at $9.7 billion, a nice little 2.4% bump year over year. And check this out, their operating income rate, that ticked up 30 basis points to 4.0%. So what does all that mean for the bottom line? It means adjusted EPS popped a solid 11%, coming in at $1.40. Pretty strong stuff.
But here's where the story gets really interesting. It wasn't like everything was flying off the shelves. This quarter was really a tale of two different consumers, you know? A story of what people need versus what they just kind of want.
So what was working? Oh man, the winners were crystal clear. Computing, for the 7th quarter in a row, by the way, was a standout. You can thank that Windows 11 upgrade cycle for a lot of that. Gaming, absolutely on fire, fueled by that new Nintendo Switch 2. And of course, the usual suspects, mobile phones, wearables, headphones, all pulling their weight.
But then you flip the coin over, and you see where things were soft. Home theater, big appliances, still dragging. And this really paints a picture of the consumer right now. Management called them deal-focused, which is really just a nice way of saying people aren't splashing out on a huge new TV or fridge unless they're getting a screaming deal.
Okay, so that's the here and now. But what about the future? This is where it gets really interesting for investors. Best Buy is playing the long game here with two big strategic bets that are all about boosting those profit margins. We're talking about their new online marketplace and their ad business, Best Buy Ads.
And when I say the marketplace is a big deal, I mean it. Get this, in just 3 months, they've expanded their online selection by 11 times. Yeah, 11x more products available than before. That is a massive, massive leap in what they can offer. And the timing, it's just perfect. The CEO, Corey Berry, basically said it herself on the call. This move is all about the holidays. It massively expands what you can buy as a gift on their site. A really smart move heading into the biggest shopping season of the year. And here's the kicker. These new ventures are already helping the bottom line. Management was clear that both the marketplace and the ad network had a positive impact on their gross profit rate this quarter. Now they're still investing heavily, so you don't see the full benefit just yet. But the important thing is, these high-margin businesses are starting to work.
All right, so after a quarter like that, you'd think they'd come out swinging for the holidays, right? Super optimistic? Well, not exactly. In fact, management kind of threw a bit of cold water on the whole thing with a surprisingly cautious forecast.
So here are the numbers they put out there. For Q4, the all-important holiday quarter, they're guiding comps to a range of -1% to +1%. You know, basically flat. And for the full fiscal year, they're now targeting adjusted EPS between $6.25 and $6.35. So what gives? Why the big beat in Q3 and then this super cautious guide for Q4? Well, a couple of things are going on. First, Q3 got a nice tailwind from back to school and some of their October sales events. But Q4, that's a whole different story. The year-over-year comps are way tougher. Plus, they're expecting that crazy growth in gaming to finally cool off a bit. Okay, so let's zoom out and put all these pieces together. What do we have? We've got fantastic Q3 execution, some really interesting long-term plays, but a very nervous guide for the short term. So what's our call? What's the investment thesis here?
So after digging through all of that, what's the final verdict on Best Buy?
All right, here's how we're breaking it down. Point 1, you can't argue with the Q3 execution. It was stellar. They showed they can absolutely deliver when there's new tech to sell. Point 2, that Q4 guidance is a major signal. Management is clearly telling us there are some bumps in the road right ahead. And point 3, the long-term stuff, the marketplace and ads, that's the future for sure. But it's early days. It's going to take time for those to really move the needle.
So, when you weigh all that, where do we land? For us, it comes out to a market perform rating. Look, the long-term story has a lot of promise, but you just can't ignore the short-term caution coming directly from management. So we think the stock will probably just track along with the rest of the market for now. And of course, a quick reminder, this is not financial advice.